Good morning, John. Here we
Morning,
are
Ben.
on October 22nd, and the Fed Chairman Powell, said he's still on target, on course for easing or reducing his buying program, i.e., getting into the tapering business. What does that mean to us, John?
Well, I'm glad he was able to take time away from his trading screen in order to address monetary policy, Ben. That's the first thing. But the Fed somehow thinks their job is to control what everybody thinks. They call it managing expectations. And the truth is, I don't think people watch what the Fed gives in their speeches. They watch what they do in order to make those expectations.
Right.
Tapering has to happen. And what are they tapering? The Fed's been buying $120 billion worth of bonds and mortgages every month for a long time. And when you buy something, it makes its price go up. And when the price of bonds goes up, interest rates go down.
Right.
So the reason they have to taper is because that has let the inflation out of the genie bottle. And we're now looking at year-over-year inflation rates using consumer prices that are in the fives, but using housing prices or stock prices, which is much more relevant. You're
Right.
talking about double digits times three in terms of price increases. So they have to actually do this. They have to stop printing money as fast as they have been. And so I expect they're going to have to do it sooner than the Fed is letting on. Probably November, December is the start.
Really. I think most of the market's pricing in the first quarter of next year. So what happens? I mean, obviously, you've been out already in the marketplace saying that means prices are going down, financial prices are going down. Does that have any direct impact on real asset prices, like real estate, for example, which we have some significant interest in?
Absolutely. And policy has been stoking real estate prices for some time now and still is. Basically, whatever they taper, as long as they're buying bonds, they're pushing mortgage prices up, mortgage rates down, and home prices up. And so in the latest numbers, the Case-Shiller numbers, we're looking at increases in prices that are in the 20s year over year.
Right.
The reason that's so important is because the economics profession is confused. They think their job is to explain GDP, which is basically what we're doing, how much we're working. And that's important because it determines people's paychecks.
Right.
But the GDP in America is really only $21 trillion. That's not even real money to a central banker these days. We have a balance sheet too, in addition to that income statement. And our balance sheet today has almost $400 trillion worth of assets, roughly 20 years worth of GDP.
Wow.
About a third of those assets are real assets like your house or an office building.
Right.
And so every time the Fed prints more money, they increase the amount of money relative to these other assets in people's balance sheets. And people reallocate just like you and I would. They take some of that money and they use it to buy buildings or houses or homes or other things. So the more the Fed buys and prints, the more they drive the asset prices up, and real assets in particular. Tapering ought to, in principle, slow that down to some degree. But as I said, the genie's already out of the bottle. If inflation is more like 5%, that means people are going to be moving money out of financial assets like stocks and bonds at some point into real assets, which ought to make those prices go up even more. So I think that's the reason we talk about real estate being an inflation hedge. And I think real estate is the single best inflation hedge you have today for what the Fed's been doing under the guise of quantitative easing.
All right. One last question, John. Related to all this is, traditionally people think about higher interest rates as bad. And, bad is a big, broad brush. Although it sounds like, by your logic, which I hardly agree with, that higher interest rates in this case is good for real estate. It can, reverse to what the conventional soundbite is about higher rates and lower asset prices.
Well, the trick there is to think of people, ordinary mom and dad, as investment managers. And they have a portfolio, and that portfolio in today is about 65% stocks, bonds, and other pieces of paper, and 35% your house and other real assets, land and so forth.
Right.
Both of those have a yield. And the yield on the house is the fact, first of all, you get to live in it. Well, the
Mhm.
equivalent bond yield is you collect a coupon, or what they call the yield.
Mhm.
Both of them have costs. You have to pay the broker for the bond, and you have to fix the roof on the house. Both of them have capital gains components to their yield. And we call it inflation for the house, and we call it increasing multiples for stocks and bonds.
Right.
Well,
Right.
the multiples are too high today, so they're going to come down at some point or other. Everybody's writing about bubbles, and they're right. But when inflation goes up, it increases the return on the house relative to the return on the stock and bond. And the fact is, raising tax rates, which is what the Biden administration is doing right now, especially capital gains taxes,
Right.
also increases the return on houses relative to bonds, because most of the income on real estate is not taxed at all. It's the invisible capital gain. Most of the income on securities is taxed. Those two things are going to cause people to take the slice of that pie that they keep in real assets
Right.
and increase it relative to the other ones.
Right.
Now, how important is that? If they increase it by 1%, geez, they've got $400 trillion of assets. 1% of that is $4 trillion going into real assets. More likely, they'll increase it for 1% for every increase in 1% in inflation. If inflation is going to be 5% higher than it was before, that's 4 times 5 is $20 trillion looking for a home in the real asset markets.
Wow.
So that strengthens to me the case for saying stocks and bonds are overpriced and people are going to be moving money out of there. So you really need to reduce your allocation there. And where people are going to be pushing their money is in inflation hedges and tax shelters, which is really real estate.
Right.
And so that's where I want the bulk of my money today to be. And to the extent that there are problems that were caused by COVID and the COVID fix, when those problems happen and interfere with people's liquidity, sometimes you can buy pieces of real assets or real estate at discount rates or bargain prices. So if you can do those two things together, catch that new trend and buy at a discount, that to me is the winning formula as an investor.
This has been great, John. Thank you.
Pleasure, Vin.